Picture this. You gave your team a work car, shouted a few staff lunches, maybe salary packaged a phone, and never thought twice about it. Then 31 March rolls around, and suddenly all of that is a fringe benefits tax question. If that sounds like you, take a breath. This is completely manageable once you know what to look for, and today I'm going to walk you through exactly how to sort it before you lodge. Let me explain the timing simply, because it catches a lot of people out. The FBT year isn't the same as the normal financial year. According to the ATO, it runs from 1st April to 31st March. So the window you're reconciling right now is that 12-month period. Fringe benefits tax is self-assessed, which just means the ATO expects you to go back through everything you gave your staff and work out the taxable value yourself before you lodge. And if you've never done this before, that's not a failure. Most small business owners are never told how any of it actually works. Here's why this matters more than it first looks. The ATO applies FBT at 47% of what's called the grossed-up value of a benefit, not the plain cost you actually paid. That gross-up is the part most people miss. A car or a round of entertainment that felt like a small friendly gesture can turn into a surprisingly large tax figure once the rules are applied properly. So the goal today isn't to scare you. It's to make sure nothing surprises you at lodgement. And there's one number coming up that changes how you look at all of this. These are the three figures that drive the whole exercise, so let me put them in your context. The ATO applies a 47% rate to the grossed-up value. Once any one employee's taxable fringe benefits pass $2,000 in a year, that grossed-up amount becomes reportable on their income statement, and some minor benefits under $300 may be exempt altogether. That's exactly why sorting each item into the right bucket matters. The difference between a reportable benefit and an exempt one often comes down to which side of these lines it falls on. This is the single number I want you to remember. If an employee's taxable fringe benefits go over $2,000 for the year, the grossed-up amount has to be reported. That's straight from the ATO and NFP law. And here's the part that genuinely surprises people. This applies even when the benefit itself is FBT exempt. Like an eligible electric car. Exempt from the tax doesn't mean invisible on the report. Hold that thought, because the next slide is where most people trip up. Now I want to be really honest with you about the catch, because this is where I see good, careful business owners get caught out. Lots of people assume that if a benefit wasn't paid as cash, it simply doesn't need declaring. But the ATO says FBT applies to plenty of non-cash benefits, and you're required to keep records and employee declarations. Even an FBT-exempt item, that eligible electric car, again, can still show up as a reportable amount once someone crosses the $2,000 mark. I know that feels fiddly, so the good news is the fix is a simple, repeatable checklist, and that's coming up right now. So here's exactly what to do, step by step. First, go through every benefit you provided between 1st April and 31st March using the ATO's guidance. That means checking payroll, reimbursements, car logbooks, entertainment, and any salary sacrifice arrangements. Second, work out the taxable value and flag which employees cross that $2,000 reporting threshold. Third, lodge your FBT return on time and keep every supporting declaration, because the ATO can absolutely ask for them later. Do those three things and you've handled it properly. No loose ends. Put these dates in your calendar today, because they're firm. If you're preparing it yourself, you generally need to lodge and pay by 2024 May. If you go through a registered tax agent with an eligible electronic lodgement, that usually extends to 25 June. That's according to ACP accountants and reporting from Yahoo Finance Australia. That extension alone is one reason plenty of people bring in an agent for FBT. Miss the window entirely, though, and a very manageable task turns into an avoidable compliance headache. One last thing to keep on your radar, because this area genuinely keeps moving. The electric car exemption rules are time-sensitive, and they changed from April 2025 for plug-in hybrid vehicles, according to reporting on the ATO changes. So a benefit that was exempt for you last year might not be treated the same way this year. My advice, don't assume anything carries over. Recheck the current year treatment before you lodge, rather than trusting what worked last time. That one habit will save you the nastiest surprises. If you've made it this far, you now understand FBT better than most business owners ever will. You know the $2,000 trigger, the 47% gross up, and the 3 steps to get it right. Your one action today is simple. Block out an hour to run that 3-step check before your deadline. If you want to go deeper on which benefits are worth offering versus which just create tax headaches, that's exactly what we cover next. I'm Sophie. I'll see you there.